Hey guys, what is up? MADSTAR Investing back again with another video. I'm sorry for the delay of my videos, but here I am once again, and today we're going to be studying about option Greeks. And option Greeks basically determine the price of an option. So here you can see this is my Thinkorswim TD Ameritrade platform, and here I'm just on the CocaCola stock right now. And I have 10 days to expiration on this options grid, and here you can see the ask price for these options. And as you can see, the more further in this strike price we go, the price of the option also increases, and that is due to one of these main four factors, which are delta, gamma, theta, and vega. And these basically almost determine the price of the option. So first of all, we're just going to start off with delta. Delta basically determines the price of the option every dollar of the stock that increases. So it doesn't matter any stock. It can be a penny stock, or a stock like CocaCola. So if Coca-Cola rises by $1, the price of the price of the option will increase by this amount here. So let's say, for example, you buy a 53 strike call for the 30th of August, which has 10 days. Then we're looking at a 77-cent delta. So options come in 100 shares, so that's why you will get $77. Okay, now it decreased to $76 every dollar Coca-Cola moves up. So if Coca-Cola moves up to $55.28, you're going to earn $77. Okay, and you can see that the implied volatility is 16.58%, and that's around $1.23 for the next 10 days. So it's very reasonably possible you can get $77 in that move, but you can also lose $20. And here, that's about it for gamma delta. Now I just want to explain quickly for the put side. So if the stock drops by 1% or $1, you have all these negative ones because delta is always measured in a positive move of $1. So let's say if you have the 55 put and that moves down by $1, you'd get $71 because put is vice versa. Sorry, I'm a bit dark here. Okay, and that's about it for delta. Delta is always measured in a positive move up of $1 in the stock price. Okay, and now we're gonna look at gamma. Gamma is basically the acceleration on to the delta. So basically, let's say you bought the 53.5 call, and that would cost you $1.12. Now let's say in around the next 10 days the stock moved $1 up to $55.20. Then you would add on 68 cents onto this. So that would be around $1.70, and you'd gain 68 euros on that. But let's say it moved another dollar upwards, then this is your measurement, and here you can see you'll earn another $21 onto that. So if Coca-Cola price in the next 10 days became $56.26, you would add $1 and it will be valued at $2 then, and you would be having a profit of 86 euros. In fact, you only put in 112 euros into it if that was the case with a $2 up move in the next 10 days, which is very unlikely because the implied volatility is only $1.23. So a $2 move is unlikely to happen. So that was just a gamma for you guys. And remember, it's always measured in a dollar move upwards. So the gamma over here will be kind of vice versa. And here you can, I forgot to mention for the delta is always valued more for in the money stocks or options. So what I mean by in the money is everything below 54 because the stock is above 54. Yeah. And everything below that would be out of the money. So let's say 54.5, the stock is right now 54.29. So if it stayed like that for the next 10 days, then it would be out of the money. And here you have your puts, and that's about the same way, just vice versa. And now it's about time to go on to theta. So theta, anywhere if you're buying the option will always be negative, guys, because there's always a time decay when you're buying options, guys, because they're assets that decrease in value every single day. So here's a measurement for every single day from now on for 10 days, and this shows how much you lose. So let's say you had the 53.5 call, the stock stayed sideways, and this ask price will decrease in the next 30 days by 30 cents. So you'd effectively lose $30 just because of that time decay, and the stock did not move upwards. And that's only the theta, guys. So buying options can be risky if you don't know what you're doing and if the option does not go your way or even just stay sideways, guys. So that is theta for you, and it will always be negative, as you can see. And also on this side, the theta is always negative. And now it's time to go to Vega. So Vega is one of the favorite for a lot of people in the options market, guys. It basically measures the implied volatility, and as you can see, it measures the implied volatility as if every 1% increase of implied volatility, you'll get $4. So what I mean by implied volatility is the market has its own volatility for the future move. So it like predetermined anticipates how much the market might move. I'll show you in a second. So here's the implied volatility. You can see 16.59%, and that's because the stock market thinks that CocaCola stock price might move $1 upwards or $1 downwards. Actually, $1.20. But let's say if that became $1.30, okay, yeah, $1.40, let's say, and the percentage became 17.5%, then this will increase as well. This will become 5. So that is Vega. Let me just show you charts. So this is what I mean by implied volatility. This is a 2-year chart for Coca-Cola, and you can see that the implied volatility here was very, very high, and it has come a bit lower. So what I normally do, or what I've learned in the past, is when implied volatility is high, the best way to profit from that is to have bearish strategies, and if it's around neutral 50% percentile, you want to have strategies like the iron condor, and if it's lower, you want to buy strategies. So if it's around 0 to 50% or 0 to 30%, then you want to buy options. That's the best time, because then implied volatility can increase. So here's the implied volatility, and rightly so. And right now it's near the 70 mark. This is like the average kind of. So right now it's pretty high, and that's why I would have um, strategies including time decay. So if I go back to my trade, I would have the theta because it's really high right now. So I would take theta to my advantage, and let's say the stock is at 54.28. The best way for me to profit would be buying this or selling this call, which would mean it would have to stay under 55. But also adding cover because selling calls you need a low margin and are actually very risky. But yeah, that's about it. This was one of my iron corners I was looking at. And I'm just sorry for the delay, guys, but I hope you learn about the option Greeks and what actually prices the ask price and what increases the price of an option. So that's about it, guys, and I hope you guys enjoyed this video. I recently moved houses, so there's a different background in the back. But I hope you guys enjoyed this video, and I'll see you guys next time.